High yield covered call ETFs are just throwing away 8%, 10%, and even 12% monthly distributions to the investors. Sounds amazing until tax season hits and you have to pay CRA thousands in unexpected capital gains tax. Let's change that. Hi, I'm Armagan. I'm a CPA who loves to talk about money, investments, and taxes. If that is something that you're interested in, why not subscribe to the channel? So before we get into the details, you should know two things. One, the complexity I'm about to explain only matters if you hold covered call ETFs in a non-registered account. So this video does not apply if your ETF investment is in your TFSA, RRSP, FHSA, or any other government registered account. So you should know where to find your tax information. For every covered call ETF you own in a non-registered account, you will receive a T3 slip. The slip breaks down exactly how much of your distribution was capital gains, return of capital, and Canadian eligible dividends or foreign income. You will get one T3 for each ETF you own. Remember that. T3 slips come later than other tax slips. You should have them by the end of March, sometimes even into early April. If you are missing some, do not panic. They often arrive at the very end. You can download them directly from your brokerage account under tax documents. So what makes covered call ETFs different? Most people assume that the distributions from covered call ETFs work like dividends. They do not. A covered call ETF holds a basket of stocks just like a regular ETF. But the cash you receive comes from two places: dividends from the underlying stocks and option premiums from selling call options. Simple enough. But here's where it gets interesting. How that cash is taxed has nothing to do with where it came from. CRA does not care whether your money came from dividends or option premiums. They care about how the ETF classifies it on your T3 slip, and that classification can be very different from what you are expecting. So when you get your T3 slip, you will see your distribution broken down into up to 4 tax categories. Each one is taxed differently by CRA. First, capital gains. Option premiums collected by the ETF are generally treated as capital gains. Only 50% of these capital gains are actually taxable. Second is return of capital. This is not a type of income at all. It is a portion of your distribution that CRA does not consider taxable in the year you receive it. I will explain it in a moment. Third, Canadian eligible dividends. If the ETF holds Canadian dividend paying stocks, a portion of your distribution might flow through as eligible dividends. These qualify for the dividend tax credit, which means a lower effective tax rate than regular income. I have a separate video which discusses the taxes on income from non-registered accounts. You should check it out if you are carrying non-registered accounts in Canada. Fourth, foreign income. If the ETF holds US or international stocks, the dividends from those stocks are considered foreign income. Foreign income is fully taxable at your marginal rate with no special treatment. The key point is that you will not know the exact breakdown of this income until you get your T3 slip after year end. The mix changes every year depending on what happens inside the fund. So let's go back to return of capital for a couple of minutes. You might have noticed that many covered call ETFs show a large portion of their distributions as return of capital. This confuses a lot of people. They think it means that they are just getting their own money back. That is not what is happening. Option premiums are generally taxed as capital gains. But if the ETF has realized losses from selling stocks, or if it has tax loss carry forwards from previous years, those losses can offset the gains during the year. When that happens, the distribution gets reclassified as return of capital instead of capital gains. So return of capital often means the fund is using losses to shelter your income, which defers your taxes to the future. It sounds great, but there's a catch. The catch is that you receive money and you do not pay tax on it that year. And this is where most investors make expensive mistakes. Every time you receive return of capital, it reduces your adjusted cost base or ACB. And ACB is essentially what you paid for your investment. When you eventually sell, your capital gain is calculated as the sale price minus your ACB. Let me show you how this works with a real example. Michael buys 1000 units of a covered call ETF at $20 per unit. His initial ACB, adjusted cost base, is $20,000. In year 1, he receives $1,500 in distributions, classified as return of capital. His ACB drops to $18,500. In year 2, another $1,500 in ROC, return of capital. His ACB drops to $17,000. In year 3, another $1,500, ACB is now $15,500. Fast forward 10 years. If Michael receives $1,500 in return of capital every year, his ACB could be down to $5,000 or even zero. Now, Michael decides to sell. The ETF is trading at $22 per unit. He sells his 1,000 units for $22,000. If he had tracked his ACB correctly, it is now at $5,000. His capital gain is $17,000. At the 50% inclusion rate, $8,500 is taxable income on whatever the marginal rate of tax Michael has. But the problem is that if Michael had never tracked his return of capital adjustments and has been thinking that ACB is still $20,000, he might have reported only $2,000 of gain to CRA. This is wrong, and CRA could reassess him for the difference. There's one more thing. If your ACB ever drops to zero, any additional return of capital you receive becomes immediately taxable as capital gain in the same year. The tax deferral stops working after that. The bottom line is that return of capital is not free money. It is tax deferral, not tax elimination. You need to track your adjusted cost base every single year. But as I explained earlier, all this complexity only applies to non-registered accounts. So let's answer another important difference: Canadian versus US focused covered call ETFs. The tax treatment changes depending on what the ETF actually holds inside. Canadian equity covered call ETFs like ZWC, HLIF or RCDC hold Canadian dividend paying stocks. The dividends from these Canadian companies may qualify for the Canadian dividend tax credit. This credit significantly reduces the effective tax rate on eligible dividends compared to regular income. For example, if you are in a 40% marginal tax bracket, interest income from a GIC is taxed at the same 40%, but eligible Canadian dividends might be taxed at an effective rate closer to 25% after the dividend tax credit. That is a meaningful difference. US equity covered call ETFs like ZWH or funds holding US technology stocks do not qualify for the Canadian dividend tax credit. The dividends from the US companies are considered foreign income and are fully taxable at your marginal rate. Then there's also the issue of US withholding tax. When US companies pay dividends, the US government typically withholds 15% before the money reaches the Canadian ETF. This withholding tax may or may not be recoverable depending on what account you hold the ETF in. For covered call ETFs specifically, the option premium income is still treated the same way regardless of what stocks the fund holds. It is the dividend portion that differs based on whether the underlying stocks are Canadian or foreign, including the US stocks. So let me give you an example that covers all of this. Jennifer puts $10,000 in ZWC, the BMO Canadian High Dividend Covered Call ETF, in her non-registered account. Over the year, she receives $800 in total distributions. Her T3 slip shows the following breakdown: capital gains of $350, return of capital of $300, Canadian eligible dividends of $150. So here's how each piece is then taxed. The $350 capital gain has a 50% inclusion rate, so $175 is added to her taxable income. At her 40% marginal rate, that is $70 of taxes. The $300 return of capital is not taxed at all this year. Instead, her adjusted cost base, ACB, drops from $10,000 to $9,700. The $150 in eligible dividends is grossed up by 38% to $207 for tax purposes. She claims the dividend tax credit, which at her tax bracket results in a roughly $30 of tax. Jennifer's total tax on $800 of distribution is approximately $100. Compare that to what she would pay if she had received $800 in interest. At her 40% marginal rate, she would owe $320 in taxes. The covered call ETF saved her over $200 in taxes on the same amount of cash received. This is why people say covered call ETFs are tax efficient. The income is real, but the tax treatment is much more favorable than interest income. Covered call ETF distributions are not like your regular dividends. The simplest approach is to hold covered call ETFs in your registered accounts like TFSA or RRSP, where all the tax complexity disappears. If you hold them in a non-registered account, stay organized. Check your T3 slips carefully to make sure you're not overpaying your taxes. The 2 videos on your screen will help you get further along in your financial journey. Check those out, and I will see you in the next one.